Silver has just closed 10 consecutive green months. 10, not 2, not 5, 10 straight. The last time this happened, silver went from $6 to $50, but here's what nobody is talking about. While Western markets trade silver at 93, China is paying 105. Shanghai is running a $12 premium on physical silver right now. They are not waiting for a dip. They are paying more, on purpose. The question is, why? Something is happening in the precious metals market that has not happened in decades, and most people are completely missing it. Silver has just closed its 10th consecutive green month. Gold has just recorded its 7th straight monthly record close. Not 1 or 2 months of strength. 10, 7, back to back, without interruption. If those numbers do not make you pause, they should. Because in the entire recorded history of these markets, streaks like this have only appeared at moments of structural change. Not corrections, not cycles. Structural change. Western silver futures are now at 94.3. That matters, because in a previous analysis, 94 was identified as the next technical objective after the inverse head and shoulders formation that developed around 72. At that time, the dominant public narrative was calling for collapse. That contrast is worth holding in your mind, not because of prediction, but because of what it reveals about psychology. Now let's build the full picture. When silver moved from 72 to 94, something predictable happened. The mood changed completely. At 72, pessimism dominated. The majority was convinced the bottom would fall out. At 94, the same majority is now anticipating all-time highs. That emotional swing, the complete reversal, happened in a matter of weeks. That is not analysis. That is human behavior, and markets are built to amplify it. Trading and investing are constantly framed as technical exercises, pattern recognition, fundamental research. But the deeper you go into market history, the more you realize that psychology and independent thinking carry equal weight to any chart. When prices fall sharply, the majority runs toward consensus for safety. When prices rise sharply, the same majority runs toward optimism for reassurance. The minority that accumulates during pessimism does not do so because they enjoy discomfort. They do so because they recognize sentiment extremes. That does not make them infallible. It makes them independent. Right now, enthusiasm is building again. But what is almost entirely missing from the mainstream conversation is the structural backdrop behind this move. 10 consecutive green months are not random. They are not short covering alone. They reflect sustained, deliberate capital allocation. And to understand what that may mean, we have to go back. The last time silver posted a streak this persistent was during the run into 1980. Silver rose from roughly $6 to $50 in approximately 18 months. That era was defined by inflation shocks, oil crises, and a collapsing confidence in fiat currency systems. Gold is showing its own historic pattern. 7 consecutive monthly record closes, the longest streak since 1973. The early 1970s were another decisive transition point. The Bretton Woods system had collapsed. The dollar had been untethered from gold. Inflation was beginning to reshape global capital markets in ways that would take years to fully understand. These comparisons do not imply repetition. History does not duplicate itself, but it rhymes. Extended streaks in precious metals have consistently appeared during periods of structural uncertainty, monetary, geopolitical, or both. In just the first 2 months of this year, gold has risen 22%, silver 31%. Moves of that magnitude are rarely isolated technical events. They tend to reflect deeper forces moving beneath the surface of daily headlines. To understand what may actually be unfolding, we need to move beyond charts and into structure. Silver is not simply a monetary asset. It is a critical industrial metal, essential to solar panels, electronics, medical devices, and advanced manufacturing. Multi-year deficits in physical silver supply have been well documented as industrial demand consistently outpaces mining output. When persistent deficits meet rising investment demand, the strain does not release gradually. It accumulates. Gold, by contrast, is overwhelmingly monetary, carrying no comparable industrial necessity, but carrying something equally powerful: institutional trust. Central banks have been consistent net buyers in recent years, quietly diversifying reserves amid geopolitical fragmentation. When sovereign entities accumulate gold, they are making a statement about their long-term confidence in monetary stability. Monetary policy adds another layer. Periods of aggressive monetary expansion compress real yields and redirect capital toward hard assets. Even the expectation of future currency debasement can alter behavior before inflation statistics confirm anything. Markets price probability, not certainty. Then there is geopolitics. Recently, oil, gold, and silver spiked together. Energy, monetary hedge, and industrial metal moving in lockstep is not coincidence. It reflects shared pricing of geopolitical risk. Statements from U.S. officials regarding Iran, reports concerning detained Americans, advisories related to regional tensions. These create a backdrop where oil supply disruptions, shipping route closures, and currency depreciation become real tail risks. Markets do not wait for events to happen. They respond to what could happen. During one recent escalation, approximately $650 billion was added to the precious metals market capitalization within hours. That is not retail enthusiasm. That is institutional positioning. When hard assets across sectors rise simultaneously, markets may be pricing scenarios that most analysts hesitate to articulate openly. Now, the mechanics beneath the price. Shanghai's silver premium currently stands near $12. Western spot trades around $93. Shanghai spot trades near $105. Shanghai futures near $108. When physical markets in one region price significantly above paper markets elsewhere, it signals divergence in perceived scarcity, a gap between what paper says silver is worth and what someone in the physical market is actually willing to pay. The ComEx Vault report from February 26 showed registered silver rising by 2.3 million ounces to 88.4 million ounces. Asahi added 824,000 ounces. Loomis 964,000. StoneX 307,000. Brinks 111,000. Yet eligible metal fell by 2.6 million ounces to 272 million. The net result was an outflow of 306,000 ounces, bringing total ComEx silver to 360.3 million ounces. Those are the reported numbers. The more significant figure is what is happening with open interest. Silver futures open interest declined from 162,000 contracts a month ago to 118,000. That is a 27% drop, while price rose from the 80s to 94. That combination is structurally unusual. When prices rise, open interest typically rises with them as new participants enter. When open interest collapses during a rally, it suggests that certain players are not entering, they are exiting. Commercial hedgers may be migrating to over-the-counter markets where margins, liquidity, and execution differ from exchange-traded structures. When hedging becomes inefficient on public exchanges, participants adapt. They move where conditions suit them better. And when that happens at scale, retail investors begin to feel it. Wider premiums on purchases, lower bids on sales, spreads that were once tight, becoming noticeably less favorable. Silver lease rates have reached 1.6%. For context, the 2023 average was approximately positive 0.04%. The 2024 average was negative 0.18%. A sharp spike in lease rates reflects concerns about delivery certainty. When lease rates rise while premiums widen and open interest collapses simultaneously, what you are observing is eroding confidence in paper mechanisms, not at the surface, but at the margins. None of these indicators alone defines a crisis. Together, they describe tension building inside a system that appears calm from the outside. Markets are not purely mechanical. They are collective expressions of fear, memory, and belief. Jesse Livermore wrote that the big money is made in the big swing, and big swings require something most people cannot maintain: patience, conviction, and tolerance for sustained discomfort. They do not reward reactive behavior driven by headlines. Independent thinking does not mean rejecting consensus reflexively. It means verifying data personally, reviewing ComEx reports directly, observing Shanghai premiums firsthand, studying lease rates rather than relying on someone else's interpretation. Crowd psychology creates opportunity precisely because acting against it feels wrong. Buying during pessimism feels reckless. Holding through volatility feels uncomfortable. Avoiding euphoria during a surge feels counterintuitive. But cycles of fear and greed repeat because human behavior repeats. Compressed systems often appear stable until they are not. Decades of intervention, paper volatility, and coordinated short-term pressure can create fragility beneath apparent calm. Springs that are compressed do not release gradually. That is not a prediction. That is an observation of how pressure behaves. So what does all of this mean? 10 consecutive green months in silver. Gold's 7th straight record close. A widening Shanghai premium. A 27% collapse in futures open interest during a rally. Lease rates spiking to 1.6%. Hundreds of billions added to precious metals capitalization during a single geopolitical escalation. These are signals. They suggest that informed capital is positioning for tail risk scenarios, even as public discourse remains focused on short-term noise. They suggest that physical and paper markets are not interpreting reality identically. They suggest that geopolitical fragmentation is actively reshaping global capital allocation decisions. Does this guarantee conflict? No. Does it guarantee sustained upside? No. Markets can retrace, consolidate, or reverse at any moment. But understanding systems is fundamentally different from forecasting prices. One area worth particular scrutiny: storage. When dealers offer unusually low or free storage, the incentives behind that offer deserve examination. Storage and buying are distinct decisions. When custodianship and dealing are combined in the same entity, conflicts of interest can arise. In stressed environments, those conflicts tend to become more visible, not less. The distinction between price action and thesis remains critical. A correction does not automatically invalidate a structural trend. A rally does not automatically confirm one. Independent verification is not optional. It is the foundation. We are living through a period where monetary systems, geopolitical alliances, and industrial supply chains are all adjusting at the same time. Precious metals are responding. The purpose of this analysis is not to create followers. If anyone ever asks you for blind trust in place of independent thinking, that is your signal to walk away. The objective here is always the same: to build frameworks grounded in data, history, and psychology. The ones who bought at 72 did so amid pessimism. The ones who will navigate the next correction successfully will do so by distinguishing between emotional reaction and structural understanding. Knowledge is strategic advantage. Markets reward those who verify, not those who echo. If you value long-form financial history grounded in evidence and context, subscribe to World Finance History. The goal here is not speed, it is clarity. And in cycles like these, clarity matters more than ever.